Hello, myself R. Shilpa, Assistant Professor, Department of BCom PA, PPG College of Arts and Science. Today, we are going to study central banking and the banking institution. Every country has a central bank that controls the banking system and maintains the financial stability. In India, the Reserve Bank of India is the central bank. It regulates commercial banks, controls the money supply, and ensures the smooth functioning of the economy. Central Bank. Central Bank is the highest banking authority in a country. It controls and supervises the entire banking system, unlike the commercial banks. It does not deal directly with the general public. Instead, it regulates other banks and formulates the monetary policy. In India, the Reserve Bank of India performs the role of central bank. It was established in 1st April 1935 under the Reserve Bank of India's Act 1934 and was nationalized in 1949. The main objective of RBI is to maintain the monetary stability, regulate the financial system, control the inflation, and promote the sustainability economic growth. For example, during the period of high inflation, RBI increased the interest rate to reduce the excessive spending and stabilize the price. Functions of central bank. The Reserve Bank of India performs the several important functions. The first one is issue of currency. RBI has the sole authority to issue the currency note in India, except the 1 rupee note, which is issued by the Government of India. This ensures the uniformity and the public confidence in the currency. Bankers Bank. Commercial bank maintain the accounts with RBI. RBI provides the loan to the banks during the financial emergency and act as their bankers. Government's banker. RBI manages the account of both the central and the state government. It collects the taxes, makes government payments, and manages the public debt. Lenders of the last resort. If the commercial banks faces the financial difficulties and cannot obtain the fund elsewhere, RBI provides the emergency financial assistance. Foreign exchange management. RBI manages the India's foreign exchange reserves and maintain the stability of the Indian rupee under FEMA regulations. Monetary policy. RBI regulates the money supply and the interest rate to control the inflation and promote economic growth. Credit control measures. Credit control refers to the method adopted by the RBI to regulate the availability of the credit in the economy. The objectives are to control the inflation, to maintain the price stability, to ensure the adequate money supply, to promote the economic growth, to maintain the financial stability. When there is excessive money in the circulation, price rise. RBI reduced the money supply through various credit controls. Similarly, during the economic slowdown, RBI increased the availability of credit to encourage the investment and spending. Quantitative and selective credit control. Credit control measures are classified into quantitative and selective measures. Quantitative measures. This affects the total money supply in the economy. They includes bank rate, cash reserve ratio, statutory liquidity ratio, open market operations, repo rate, and the reserve rate. Selective credit controls. This controls credit for the specific sectors. They includes margin requirement, credit rationing, moral succession, consumer credit regulations. This measures helps direct credit towards the productive sector and prevent the misuse. Role of RBI. The Reserve Bank of India performs several important roles. It regulates the commercial banks, supervises the financial institution, controls the inflations, maintains the stability, promotes the financial inclusion through the banking facility in rural and the urban areas, ensures safe and the security payment system, protects the interest of the deposits. State Bank of India. The State Bank of India is the India's largest commercial bank. It has a special position because it is the largest branch networking in the country. It provides the banking services in the rural, semi-urban and the urban areas. It acts as the bankers to many government departments. It supports the financial inclusion by providing the banking services to every section of the society. It offers various services like saving accounts, loans, internet banking, mobile banking, and the investment services. Commercial banks and the rural financing. Commercial banks contribute significantly to the rural development. They provide agricultural loan to the farmers, loans to micro, small, and the medium enterprises, priority sector lending, financial assistance for education, housing, and the self-employment. Regional Rural Bank and Cooperative Bank. Regional Rural Bank were established to serve the financial needs of the rural people. The objective includes providing affordable credit to farmers, supporting rural development, encouraging small business and self-employment. Cooperative banks are owned and managed by their members. They provide agriculture loans, small business finance, short-term credit, and the rural development support. Conclusion. To conclude, the Reserve Bank of India is the backbone of India's banking system. It regulates banks, control inflation, and maintain the financial stability. Institutions like State Bank of India, Commercial Bank, regional rural banks, and the cooperative banks contribute significantly to economic development by providing the banking services to different sections of the society. A strong banking system supports savings, investment, employment generation, and overall national development. Thank you.